Investor intelligence provides general information only. You should consider seeking independent advice to see how this information relates to your unique circumstances. Please refer to the terms and conditions available at investorintelligence.com.au for more.
Welcome to this week's episode of Investor Intelligence, your weekly podcast on all things investment, hosted by me, Jacob Kearns. Land tax is a topic that can cause a lot of confusion among property investors in Australia. So in this episode, we're going to unravel what it is, why we pay it, when you should start to worry about it, and more importantly, how to manage it effectively. So I have with me the Senior Property Mentor at the Property Mentors. Welcome back, Pat.
Thanks, Jacob. Thanks for having me. Looking forward to going through some land tax.
Yep, let's dive into it. So Pat, firstly, can you tell us what it is?
Alrighty, so before we get started, Jacob, I just want to make it clear that I am not an accountant. So anything that we go through today is just going to be general information. If you are seeking advice around how land tax or any other taxes could affect you directly, please speak with your accountant. Just let them know your situation and they'll be able to give you that advice. So today, just the facts. Land tax is an annual tax that landowners pay. So if you are an investor and you own an investment property, you will pay land tax. If you own a principal place of residence and you live in that property, you won't be paying land tax on that property.
So just on investments?
Just on investments. So it's important to note that land tax is basically a revenue-raising tax for the government. It's very similar to stamp duty, which the government sort of rely on for a few things, but it's a tax that you pay the government for owning that land.
Yeah, okay. And how's it calculated?
Well, land tax is calculated on the total taxable value of the land component of your investment. So let's say you've got one investment and you have that one investment in Victoria, for example. That land tax is calculated on the land component of that investment property. So the actual building itself and what that's worth doesn't factor into this. It's only the land itself.
Right.
So let's say you've got two investment properties in Victoria, for example. The land component of both of these properties will be added together, and then you'll pay land tax on the combined value of those two land components, if that makes sense.
Yeah, and it's just in that state, right? Like the threshold is across different states.
Yeah, so it's important to note that land tax is calculated differently between states. So each state have their own sort of thresholds and calculations that they do to get their land tax payments. So it's important to understand each state's different rules and regulations, but every state is calculated on its own. So if you've got three investments, let's say you've got two in Victoria, one in Queensland, your land tax bill in Queensland will only include the land component of your investment property in Queensland, not the two in Victoria. And that's the same for the Victorian ones. It will only include the land component on the two investments you've got there, and then your Queensland property's land component will be calculated separately. So in that case, you would get two different land tax bills.
Yeah.
One from Queensland, one from Victoria.
And it's not tax deductible, is it?
No, it's not tax deductible. So similar to stamp duty, it is a tax, so you can't really get out of it, but it's not going to be tax deductible either.
Yeah. And so how does it affect investors, whether it's someone just starting to grow their portfolio or someone who's got a few properties? When should they start to think about it?
Everyone should think about it. So the best way to think about land tax is that it is a cost of doing business. So it's something you can't avoid. There are ways to mitigate it, but it is a tax that you ultimately will have to pay. It's important to factor it in to your investing, and especially when you start accumulating a lot of land or a certain amount of properties in a certain state, the land tax could add up. So it's important to understand the thresholds involved. But when we're looking at an investment, it's not a defining factor. Would you rather focus on the investment fundamentals behind the investment itself, or would you rather focus on where you're going to get the cheapest land tax?
Yeah. So you shouldn't be diversifying just for the sake of avoiding a bit of land tax.
Yeah, I would say that. You don't want to diversify purely because of land tax. You want to diversify going back to your strategy.
Yeah.
If the strategy says, okay, it's probably a good time to start diversifying and looking at other types of properties in other states and that sort of thing, then by all means, but we're not going to do it purely to avoid land tax. There's got to be a few reasons behind it to make any investment decision, really.
And so you mentioned it works like a threshold in each state, similar to your income tax with a similar threshold there. How much is it? Like if you could give an example for maybe the lower end versus the higher end that people would be paying.
Yeah. Okay. Well, let's look at Victoria, for example. Victoria has a threshold system. So the first threshold is $0 to $50,000 as your land component being valued. So in this case, if you owned a piece of land in Victoria that was worth $48,000, you wouldn't pay any land tax.
Right.
You wouldn't have a land tax bill. If you can find me a piece of land in a good area, Jacob, that's $48,000, please let me know.
Yeah.
But if we go a step up from that, $50,000 to $100,000 is the next threshold. So in this case, you would pay about $500 worth of land tax annually.
Yeah.
If we were in the next threshold, so the 100 to 300,000, based on my members, this is where most of my members are sitting in at the moment, you'd be paying around the $975 mark for your land tax.
And that's per year, right?
Per year.
Yeah.
So it's really not that much if you're sitting in that threshold. The next threshold would be the 300 to 600,000 mark. So in this case, it's calculated a bit differently. It's not a flat rate. It's $1,350 plus 0.3% of your total land component's value.
Right.
So as an example, if you owned, let's say, $460,000 worth of land in Victoria, your land tax would be $2,730 for that year because it's $1,350 plus 0.3% of $460,000.
And so back to your point though, like even if you are on that higher end, it's still not going to be, you're not going to be making your investment decisions purely because of that. Like it might mean you do start looking to diversify a little bit more in other states, but you're looking first at the growth fundamentals of the property, looking back at your strategy and sort of making a decision based off that rather than how can I avoid paying a little bit of land tax.
Yeah. So that example there, $2,730 for a $460,000 land value, that's like 0.5% of the total of the land's value.
Right.
So it's not even 1% of the value, and that's what you pay to the government for holding that there. So it's really not that much out of everything. But the investment fundamentals really need to come into play here because if you focus on the investment fundamentals first and you get a piece of land that's in a higher growth area, it could be growing at 6, 8, 10% per year, really offsetting that land tax that you are paying.
Yeah. You mentioned before that, it's a government tax designed to give them revenue, but why do we pay it? Like, what do they do with that revenue?
Yeah, really good question. It's actually a good thing, believe it or not. Yes, it's a tax. Yes, every investor has to pay it, but it goes back into infrastructure and public services and improving the area that you're in. So it's the same sort of thing with your rates. Those payments that you pay go back into local infrastructure, back into the local area to improve it. So as you can imagine, if that's happening in your council, your state, your city, where your investment is, that's going to keep improving the value of your property because your property now has access to more infrastructure and improved public services, and just a general area that it's in is being improved constantly.
Yeah.
So,
yeah. And another interesting point that you brought up previously on this podcast was that it shouldn't be looked as a negative thing, but also generally when you're paying more land tax, the property values is going up. So you're going to be paying more land tax on that. So it's kind of like generally because you're earning more money. Again, it's sort of a good thing if you're paying more land tax.
Yeah, you could definitely say that. And it's actually funny that you mentioned that. I saw an article last week. Can't remember the actual article, but I remember the heading was something like Queensland is slapped with extra land tax bills or something like that. And I read through the article and I was expecting some sort of change to the land tax regulations in Queensland. But as I read through, it was actually because of valuations being higher. So the media are very good at articulating the fear in people and getting that across in the right way. And it definitely had me hooked as soon as I read the title. But as soon as I delved into it, it's actually because all of the investors in Queensland that were paying extra land tax, it's because their value's gone up.
Yeah.
So again, it's
Media love their clicks.
yeah, they love their clicks, and the growth that they would have seen in their properties really would have offsetted the extra land tax that they're paying anyway. So it's a good thing if your land tax is increasing naturally because it means that your values are increasing, and the valuer general who oversees all of the valuations that the government makes is valuing your properties higher. So definitely not the worst thing in the world as an investor, but understanding the figures behind that is important. So understanding your land tax bill versus the performance of your property is probably a good way to look into the numbers and make sure that your investment's still performing.
So Pat, for most of us who are on the lower end of the threshold, why is it still important to keep up to date with land tax and to understand how it affects your investment portfolio?
Well, it affects the investor themselves. So anything that affects any investor, you should be on top of. And I know that experienced investors always are on top of these sorts of things, whether they're on top of it themselves because they've got the time to do it, or whether they have someone like myself as a mentor who's always on top of these things, helping them preempt any changes or deal with any changes that they need to make or that are made by the government, because these things are changing quite often. There's articles popping up all the time. There's legislation being changed or proposed to change, and being on top of this and understanding what's going on with land tax and other taxes involved in property investing is important. So, because it could affect you as the investor. If there's a big change that happens, it might not be implemented straight away. So we've got time to plan for those things. So experienced investors will always be on top of any changes that are being made.
Yeah. And how does it work when you have joint ownership of the land?
Yeah, that's a good question, Jacob. Probably the best way to explain it is, let's say me and you owned a property together.
Mhm.
If we both weren't married and we had our own portfolios and we decided to buy a property together for some reason, let's say you have 10 properties and I've got 5. You might have 10 properties in all sorts of different states across Australia, and I might have just 5 properties plus this one that we have together, all in Victoria. So there's 2 ways that you can get assessed on this. If we wanted to be assessed as individuals, we would both receive our own land tax bill. So if you've got one property in Victoria plus this one that we're split owners of, your land tax bill would be different to mine because I've got 5 properties in Victoria plus this one. So knowing the threshold system, it might not make sense for you to be assessed with me, because if we assessed them together and got the one land tax bill together, you would be getting a land tax bill that would be quite larger than what you needed to, because you're getting assessed with me, who's already got 5 properties plus this one, and you've got another one in Victoria plus this one. So the land tax bill would be quite large, and then we would say, okay, let's split it 50-50, but that wouldn't make sense for you because you've got more assets in Victoria than I do, or less assets in Victoria than I do. So you would, in that case, do it separately.
Yeah.
I would get my own land tax bill and you would get your own land tax bill.
Yeah.
If we were married, so let's say we were married, we would have typically, if you were married, you might have 6 properties together, let's say. In that case, you might get assessed together and get the one land tax bill because all of your assets are owned together.
Yeah.
And you would therefore have the same land tax bill. So it would make sense to say, okay, let's just get the one bill and let's just split it, or however you would do it in that scenario. But it would make more sense that way.
Yeah. So again, it's based off the investor's portfolio. Land tax isn't an inherent value of the piece of land itself. It's calculated by the amount of land the investor holds in that particular state.
Yes, that's a really good point, actually. It's based around your situation, similar to your own taxable income. The one piece of land that you own, let's say, doesn't have its own land tax figure. So it relates to the amount of assets that you have in that state.
Yeah.
Which is why it's important in that scenario where we both own a property and we have our own separate portfolios as well, is that we need to be assessed differently, because I would have paid more land tax than you. So we would want a different bill for that.
So when would it get to the point where someone really has to start worrying about this stuff?
If you inherit 10 acres of land, Jacob, on the outskirts of Melbourne CBD, come speak to me.
Right.
That 10 acres of land on the outskirts of Melbourne would probably be of high value, and you would probably be paying a substantial amount of land tax in that case, potentially.
Yep.
So if you came to me with that and you said, Pat, I want to invest in Victoria, where do I go from here? We really need to consider that, because you might be paying quite a lot of land tax already. You might be in quite a high threshold, and to invest again in Victoria might not be the best decision for you at that time. There might be better options. Again, we need to consider the investment fundamentals first and how that's going to offset the amount of land tax that you'll pay. But it's important to start considering in a situation like that. So it's probably no certain amount of properties that you would want to get to. Like, it's hard to say once you get to 5 properties in Victoria, let's say, no more investing here, let's diversify.
Yeah.
Because different properties have different land contents as well. So if you had 5 apartments in Melbourne, let's say, you might not be in that high of a threshold, because the land component of that property isn't really going to be that much, because it's an apartment. So if you said to me, Pat, I've got 6 300 square meter blocks in Melbourne, then, okay, maybe we should have a discussion and look at diversifying. It's not really a concern. It's more of a let's diversify and figure out, firstly, the investment fundamentals behind our next property, compare that with our estimated land tax, plus all of our other expenses using a cash flow projection software like Augur, and really understanding the numbers behind it and the expected performance from that regard. So
one other thing you mentioned earlier was with the media, the clickbaity headlines and titles that they use. If someone's looking to invest or they have a portfolio already and are reading these headlines, how do they go about sifting through all the noise in the media?
Yeah, good question. So as you might know, there is a lot of noise out there, whether it's the media, whether it's news articles or whatever it is. The media are very good at what they're trying to get across, whether that's fear, excitement, whatever it is, they're very good at it. And at the end of the day, it's all to get their clicks or their reads or whatever it is. So the media are always going to put a big headline there saying Queensland is slapped with extra land tax or humongous land tax change in Victoria or something like that. It's to grab people's attention. As you read through the article, and if you understand what's actually going on, then it might not really be that big a change. So it's important to consult with your mentor and understand their point of view, because they will be an expert on the topic and they've probably already read the article. Like, I have this conversation on a daily basis with my members around land tax and teaching people around land tax and all of the other investment fundamentals. So we know what we're talking about and we know what's going on in the market. Having that person by your side is a really good way of navigating through the noise.
Yeah.
Whether that's land tax or stamp duty or deductions or whatever it is, it's important to have someone there to help you navigate through it. If you are scared of land tax, speak to someone about it. Speak to an expert about it, because a lot of the time it's really not going to affect the everyday investor. If any changes were to happen, it's most likely not going to affect you, unless you've got 10 acres of land on the outskirts of Melbourne, or actually if you are a developer. So if there is a change, it's usually developers that are going to be the ones that cop that change. Because if you think about a developer, they're probably owning millions of dollars worth of land at any one time. So if there's a slight change or a big change, it's most likely going to be them that is affected. So just have that person there. Keep on top of things, understand what's going on. And every investor should be doing that with all of the investment fundamentals. Whether you pay someone else to help you do that or whether you try and do it all yourself, it doesn't matter. My advice would be to keep on top of the changes and preempt them, understand what's going to happen, and then plan for those changes if you need to. The other reason why land tax is quite helpful, you could say, is it discourages inefficient use of land. Okay, so let's say you owned a piece of land here in Paran, a 300 square meter block. If our listeners out there aren't familiar with Paran in Victoria, it's only 3 or 4 k's from the city. It's very close to all of the infrastructure nearby. You've got Albert Park Lake, there's hospitals, there's tram stops, there's everything is close by to Paran. So if you've got quite a big block that could be developed or could be used for something, and you're deciding not to use that, you're just land banking and holding it, the government would see that as being an efficient use of that land because that land is close to everything and it's just sitting there doing nothing. Mm-hmm. So if you've got that piece of land, probably valued very high because that land could be used for all sorts of things. And your land tax bill, if you own that piece of land, would most likely be quite high. Therefore, if you own that property, it's probably going to be a case of, okay, I'm paying X amount of dollars every year to hold this piece of land. It's sitting there doing nothing. It could potentially be a deterrent for someone holding that land to say, yeah, I actually need to do something with it. I need to start getting some sort of income from this, or I need to sell it to someone who can do something with it. So it encourages development because if you're a developer as well, holding millions of dollars of land and you're just land banking, you would be paying quite a lot of land tax. So in that sense, you would want to theoretically develop that land quite quickly so that you're not out of pocket so much by holding on to millions of dollars of land. You want to build on it and develop it and move on so that you don't need to keep paying that. It creates a sense of efficiency, and that's good for not only you as an investor in that suburb because there's more and more infrastructure and property being built, but it's also good for the area itself so that it continues to be developed into a good suburb, basically.
So as we wrap this up, Pat, how would you summarize what we've discussed here today?
Firstly, can't avoid land tax. There's 2 things in life that are certain, and that's death and taxes. You can't avoid it. There's ways to mitigate it by speaking with your accountant or speaking with the right experts about it. It is a cost of doing business. As investors and as advanced investors, we need to factor it in. We need to be aware of land tax. We need to be aware of changes around land tax, and that's anything to do with your investment portfolio you need to be on top of or have someone who's on top of it for you. Everyone's happy to give away 30, 37, 45% of their incomes every year to the ATO without doing anything about it. But there are so many people that I speak with who are worried about land tax, and they're worried about that small amount of tax that they have to pay every year to hold an asset that's growing in value for you and improving your long-term wealth position every single year. So to me, it doesn't really make sense that you'd worry about it. In the eyes of someone who doesn't understand land tax, I can see how it might worry someone like that, but that's why it's important to understand it first, speak with the right people to get an understanding of how it's going to affect you, and just keep in mind that it is a cost of doing business.
Yeah, that's a good point. I think it's important to remember and factor in any tax benefits that you're getting in the form of deductions and depreciation for holding the property and compare that with the amount of tax that you're paying for the value of the land that you hold in that state. And it's hard for investors to figure out what or how that information applies to them and their unique situation. So I'll include a booking link to the description of this episode. So if someone wants to reach out and discuss anything that we've talked about so far or anything related to property, then they can book in a time to speak with you.
Yeah, not just me, who's important. So as you know, I'm not an accountant. It's important to speak with your accountant about the physical changes that could happen to you.
Yeah.
As a mentor, I can help you understand the changes that are happening and what's going on, but I would never be able to relate that to you and say, hey, Jacob, this is exactly how this is going to affect you, or this is exactly how you could mitigate this. I can't give that advice, and as mentors, we can't. So having that right team around you is
Yeah.
really important as well. So we can definitely help with getting the right accountant in front of you to make sure those changes are being implemented or planned for.
Awesome. Well, thanks, Pat, for coming on. It's been awesome talking land tax with you, and I look forward to having you back on again.
Thanks, Jake.
If you found this episode or any of our episodes helpful, please make sure to share and leave a rating to help us reach more people on their investing journeys. And of course, subscribe to be notified when new episodes drop. Make sure to follow the podcast on Instagram at Investor Intelligence Podcast. You can find links to our other socials in the show notes, including a link to the Property Mentors weekly blog. If you're ready to get your property portfolio in shape for financial freedom, check out Luke's latest book, Property Fit. You can get yourself a copy at www.propertyfitbook.com.au.